Our next guest says the Treasury market is literally and figuratively captive to the news from Japan. William O'Donnell is head of Treasury strategy at RBS Securities, and he joins us now from his firm in Stamford. William, good to see you. Amazingly, I think, if we look back to the middle of December, the beginning of December, we haven't seen Treasury yields respond to a lot of the crises in North Africa, in the Middle East, like we might expect. We didn't see a massive flight to safety trade. Are we getting the beginnings of that finally now?
Yeah, and I think the beginnings came last week. If you look at the IBD consumer sentiment survey that was followed shortly after by the Michigan survey that we got late last week, both plunged, and I think it was all somewhat directly or indirectly related to the Middle East turmoil and higher energy prices. And you still have oil prices up near $100 a barrel. You still have the national average price of unleaded gasoline peaking currently somewhere in the vicinity of $3.55 a gallon. And I think what the consumer sentiment surveys are showing is that households are beginning to say no mas maybe to the the discretionary spending boomlet that we've had since roughly Thanksgiving of last year.
Now, I was reading your morning note, and you say that, the next technical support level could be closer sort of to the 3% level for 10-year Treasury yields, right?
Yep.
We're just below 3.3%. What drives that yield that low?
Well, first of all, it's going to be fundamentals and sort of external events, such as what's going on in Japan, especially, and also in the Middle East, and maybe even in the Eurozone debt markets. But I think what's most important and what's the backdrop to the rally that we expect to continue in Treasuries is the fact that investors, by our statistics and data, seem to be still dramatically underinvested and still somewhat bearish on Treasuries. And we just think that that's the foundation for people ultimately covering shorts in the bond market and perhaps even getting long the Treasury market.
Now, there is some suggestion that, who knows what exactly is going to happen to Japan in the next few days and in the coming weeks, but there's this notion that they are going to have to repatriate a lot of cash from overseas, and they are a large holder of U.S. Treasury debt. Is that having sort of a supply-demand or a technical effect on where markets are trading at the moment?
Well, it did yesterday, and you could see there was notable weakness in the 30-year sector of the Treasury curve. But that sort of came and went during the morning hours. And I think what people did was they went back and looked at what transpired in the JGB market as well as in the Treasury market during in the wake of the Kobe quake. And there was very little evidence that the JGB or Treasury markets suffered, at least in the short to intermediate term, as a result of repatriation of foreign bond holdings back into yen.
Now, when the Fed releases its statement today, what are you looking for? What would be a surprise to the markets?
I think the surprise to the market is if they shift at all from the verbiage that came out in the January statement. The world seems to be in increasing turmoil and in increasing uncertainty. You have stocks gyrating wildly, commodities gyrating wildly, Treasury yields gyrating. And in a world where there's uncertainty, it's no surprise to me, one, that people are flooding back into Treasuries, and two, I think it would be a great surprise that if the FOMC dramatically changed the FOMC statement today versus what it was back in January.
Bill, if it was going to dramatically change very quickly, we have about 10 seconds here, which way would it change?
I think that if it changed at all, I think that they would have to flag the risk, the near-term outlooks, or the near-term risk for U.S. growth, given what's going on in the Middle East and in Japan.
Would that mean a possible recommitment to a QE3, perhaps?
Oh, I don't think they'll make any commitment toward QE3. I think they're still deciding what to do at the end of QE2. I just think what we're doing now is looking, as they always do, at the growth forecast in the short and intermediate term, and I don't think they like what they see happening around the world and in the equity markets today.
All right, Bill, thanks so much for joining us. Really appreciate your insight. That was Bill O'Donnell of RBS Securities.